When I was 20 years old, at the time, I had no idea about what went into the house buying process. I walked in completely blind, and there were some things that I wish I knew back then that I know now. Needless to say, after buying a home, then becoming a real estate agent shortly after, and after helping thousands of families buy and sell real estate, there are 10 things you absolutely must know before you buy a home, and the last few on the list are really important, so watch to the end. These 10 things kind of just scratch the surface of what there is to know, and I'm constantly shocked to find that the majority of real estate agents either don't know them either, or they don't tell their clients about them. My name is Mike Perna. I'm a local real estate agent here in Metro Detroit, and our agents are trained to fully go through the buying process with every client, giving them all of the options every step of the way so you can make the best decision for you and your family when you're buying a home. We are always here to help, and on with the video. The first thing that you must know before trying to buy a home is just because the bank proved you, it's not the end of the process. There's a big misconception that when a bank pre-approved you for a mortgage, it's the same as being approved for financing, but that's not the case at all. A pre-approval letter does not guarantee that you're actually going to receive financing from the bank. A pre-approval is just the bank's way of saying that they will likely approve you for a certain amount of money for a mortgage if you can make it through the underwriting process, which is typically a huge hurdle by itself. It means your credit report, your W-2 or 1099 information provided has determined by looking at the surface information that they would consider lending money for a home. The remainder of the process is going deeper into your finances and also conducting an appraisal on the home. The appraisal will be sure the price you're paying is at least roughly in line with the market, you're not overpaying by an egregious amount, and any glaring issues with the home will be noted and needed to be fixed even on conventional mortgages. More specifically on FHA appraisals. When talking to a loan officer, at the time they issue a pre-approval, ask them for the list of conditions. The underwriter is going to issue a list of conditions even if you don't have a home yet. Now, by getting a jump start on this, starting to gather documentation in advance is going to significantly lower your stress level versus rushing last minute, as a lot of loan officers will hold that information until you find a house. I just purchased another home myself, and the underwriter wanted my actual tax transcripts mailed from the IRS, and that takes 3 weeks, and I'm glad I knew that before I found the house because it gave me time and I didn't have to push back the closing, I wasn't under the gun, and I didn't potentially lose the home. Number 2, often when a buyer asks a lender if they can get a mortgage for, let's say, $500,000, the lender will approve someone for that when they can afford quite a bit more. If the perfect home sits at $575,000 and it's worth going up $75K to get into a better neighborhood or a different school district, many people automatically assume the original $500K is the max amount. This was the exact scenario with one of my recent clients. $75K more in house, in this case, meant that they didn't have to send their 3 kids to private school, they could do public instead. That is a $7,500 per year per kid that they could save. Even though their payment was $403 higher per month or $4,800 per year, in the end, asking the question to the loan officer saved them several hundred thousands of dollars in education bills. Before we get to number 3, I would truly appreciate it if you'd hit the like button so this video gets out to more people who need this info. And while you're there on the screen, hit the subscribe button to keep up with our videos. Number 3, when it comes to the pre-approval, just because the bank pre-approved you for a certain amount of money doesn't mean that you should use or need to use all of it. Lenders use your income and credit score to determine how much home they think you can actually afford. But just because the bank thinks you can buy a certain amount of house does not make it a fact, because there are other factors in the future you have to consider that might be completely out of your control. For example, you may have a steady income with a secure job now, but in today's world, that job is never necessarily guaranteed, and the last thing I want to see you do is buy a home at the very top of what you can afford based on your salary, but in the end up in deep trouble if you were to ever lose that job or end up in some other type of hardship. Plus, having a smaller mortgage means that you can save more money at the end of each month to put into your emergency account, not to be touched, and then into your retirement account and general investing brokerage account. And so even if the worst case scenario were to happen, like you lost your job, because your mortgage is smaller than you can actually afford and you have a 6-month reserve built up now, you'll be able to make ends meet until you find a new job. And that actually brings us to the next point. Number 4, being house poor sucks. House poor or house broke means that you're spending a disproportionately high amount of your income on your house, which includes your mortgage payments, your insurance, your taxes, maintenance, utilities, and anything else associated with your house, leaving you broke at the end of the month. Each month, you barely have enough money to afford the basic necessities in life after your house payment, like groceries or a car payment or just basic entertainment. Mortgage companies are going to approve you for mortgage payments of 36 or even as high as 43% of your pre-tax income. That barely leaves enough to keep the lights on after taxes, house payment, and no car payment. Instead of jumping all the way to the max 43%, I advise our clients to use the 28% rule when looking at a home. And here's an example. If you're earning $100,000 per year, then ideally you shouldn't be spending more than $2,333 per month, or about $28,000 per year towards all household expenses. Now take that payment and match it up with a mortgage amount working backward from the monthly payment goal. So right now, $2,333 per month on a 20% down loan is roughly a $340,000 loan at $1,825 per month, leaving room for taxes and insurance in the payment and still be at or under $2,333. So in this example, with 20% down, you'd have the ability to buy a home of $425,000, still put dollars into an emergency fund and a retirement account, and not go broke. At 43%, the absolute max amount in this example, $43,000 of the $100,000 income is spent on a mortgage per year. Add in the $25,000 paid in income taxes, that wipes out almost 2/3 of your entire income, which is not a good spot to be in. Traditionally, the thought was to get the biggest mortgage possible, get the biggest, baddest house possible, and although it'll be tough for a few years, wages always go up. Well, we're in a world now where wages don't always go up, and clearly low inflation isn't guaranteed either. With inflation rates in the 7s, 8s, and 9s, I don't want to see a buyer buy the most expensive home that they can buy and then all other bills go up, literally going negative every month. Number 5. There are expenses that most people don't consider when they're buying a home, and oftentimes a lot of these expenses are hidden and completely unexpected. Some of these include property taxes, which depending on where you live and the size of your house could be a few $1,000s per month or more. I see a lot of people underestimate how high property taxes are, especially buyers moving in from out of state, where some of the other states have low or even no property taxes. I advise people looking at homes to assume around 2% of the home sales price is going to be your yearly tax amount. So if you're looking at homes about $350,000, then you can expect to pay somewhere in that $7,000 range, or about $583 per month. Now, this is a little high, but I'd always advise being a little cautious when it comes to that number. Overestimate $50 or $100 a month so that you're not surprised. When you start to zero in on the exact home you like, we call the assessor's office to find what the next owners, what you, will pay in taxes. We did a deep dive into the difference between assessed value and taxable value, plus the Headley Amendment here in Michigan on our YouTube channel. Watch that one for more info on what they pay may not be what you pay. Number 6. Homeowners insurance. All banks and mortgage companies are going to require that you have this before they actually lend you the money, and often you're going to get a discount for paying upfront for an entire year and bundling with auto and any other type of insurance that you have. Now, there are 2 things to watch out for here. First, your best bet is to go to a broker, not a single company directly. I made this mistake for years and thought that going to a broker, they would have additional fees, and what I didn't know was that my insurance rates could be shopped at 20 plus companies, and I was able to reduce my insurance payments by about 1/3 and get better coverage. Number 7, a little bit more on insurance. Here in Southeast Michigan, and frankly anywhere in the United States, this is important. More than 13% of Americans live in the 100-year floodplain. In Southeast Michigan, Metro Detroit, and Ann Arbor, that number is just a bit higher. Now, if you're buying a home in a floodplain, you're going to need extra flood insurance that runs a few $1,000s extra unexpected per year. When you're looking for a home, be sure that your agent is equipped with the knowledge to look up the home on the FEMA floodplain maps. I see this all the time where I'm at a closing with one of my sellers, and the agent didn't look this up for their buyer, costing them a few $100s every month in additional insurance coverage that the mortgage company requires. For the right home and the right deal, it can definitely be worth it, and I've had buyers buy in a floodplain, but for my buyers, it never came as a shock. Now, before we get to number 8, I truly appreciate it if you hit the like button so this video gets out to more people who need the info, and while you're there on the screen, don't forget to hit the subscribe button. Number 8, more on unexpected home expenses. Some of the things in your home, like the HVAC system, windows, and the roof, are going to have to be replaced at some point in the future. Those things just don't last forever, and I can guarantee you it's not going to be cheap. I just recently had to replace a roof and it cost a little bit over $10,000, just to give you an idea. And I know that all sounds like a lot, and I promise I'm not trying to scare you out of the home ownership. I personally love owning a home, and I could never imagine renting again. When you're figuring out your monthly payment, I advise clients that they imagine this being built into it. The 4 monthly expenses on a home are going to be principal paid down every month on your loan, interest paid on the loan, taxes on the property, and insurance, or as is commonly referred to as PITI. Add a silent M to the M for maintenance, and I advise budgeting roughly 0.5% of the purchase price of the property per year. I add to an emergency fund myself monthly, so I don't even see it in my bank account. So here's an example. If you're buying a home for $300,000, expect about $1,500 per year, or about $125 a month, will eventually have to be spent on the roof, windows, furnace, AC, hot water tank, and other maintenance. Over 20 years, that's about $30,000. I may be just a little high with the estimation, but if the furnace goes out, I'd rather you budget ahead of time for that $10,000 new heating and cooling system. Number 9, your credit score. The next thing that you should know before buying a home is that your credit score is extremely important. It can determine if you even qualify for a mortgage in the first place, and it can affect your mortgage interest rate depending on what the rate is. For your mortgage, it could be the difference of paying hundreds of dollars per month. I highly recommend that you build up your credit score to at least in the good range, which sits between 670 and 739. Can you still get a mortgage with a lower credit score? Yes. But as you see in a little bit later in this video, having a lower credit score can affect things like the type of mortgage that you can qualify for, as well as what we just talked about, paying extra every month. Here's an example. Suppose you want to buy a home for $300,000 and you're putting 20% down. Today's mortgage rates, you'd be paying roughly $1,810 per month for your mortgage. However, instead of a 750 credit score, let's say that you had a 640 credit score. That would increase the payments because of the higher interest rate that you qualify for to $2,000 per month. That's $200 more every single month you're going to have to pay because the credit score is at 640 versus 750. It is super important that you keep track of your credit score, and in my opinion, there are 2 great programs to look at when you're doing that. The first one is Smart Credit, the second one is Credit Karma, both of them being free. Both of these tools also have simulators, so if you take action like paying down a credit card or maybe adding a car loan, it will project what will happen to your credit score as well. They're also both going to let you take action on negative reporting by sending letters directly to the creditors on your behalf with the push of a button. For a good example of this, I'm going to use my own experience. I leased a truck last year and make payments to GM Financial. They mistakenly applied my first payment on my new lease to my old account, the car that I had already turned in, then reported that the first payment was late. It just wasn't made. If I wasn't watching, that would have cost me a few $100s per month a few months later when I went to buy another house. Credit Karma alerted me and I submitted a dispute right there on their site. I also called GM Financial. Now, Credit Karma's dispute got the laid off in 30 days. 4 months later, I was still getting letters from GM Financial saying that they were looking into it and had no news yet. They eventually, a year later, from another department, mailed me an overage check closing out my old account, which happened to be the exact amount of my new payment. Number 10, the 20% down requirement is a myth. And for some buyers, waiting to put more down can actually be financially harmful. Now ride with me on this one. For myself, I usually put between 20 and 40% down on a home depending on the situation. But here's the tale of 2 buyers that we had and we were working with in 2019. One had 5% down, the other had 10% down but was trying to save to 20%. I advised both to just go ahead and make a purchase now. The 10% down person waited until they had 20% and bought a home in 2022. But the homes that he was looking at went up in value from $300,000 to $375,000. His payment actually would have been lowered with less down 3 years ago. The one that did buy a home in 2019 paid $314,000. Now, I monitor our past clients' equity positions, and when I felt earlier this year that he had 20% in because the values had been rising, I connected him with an appraiser. Now, the home reappraised at $392,000. Here's why this is important. When you put less than 20% down, you've got to pay what's called primary mortgage insurance on conventional loans or mortgage insurance premiums on FHA loans. For my client at $314,000, it cost him $122 a month on his loan for the PMI. Here's the myth on that one. You've got to refinance or you've got to wait until you make enough payments to bring the balance down past 80%. This is false. It's based on the value of the home right now or any point in time, not just at that point in time when you buy it. In early 2022, with the appraisal coming in showing well over 20% equity, I typed up the letter and gave it to our client, and he mailed it with the appraisal to the mortgage company, and they dropped the MIP, aka the payment, $122 a month within 60 days. For this young family, that's $1,500 per year back in their pocket. His payment dropped from $1,380 to $1,258. Now, I understand this is not life-changing money, but I would rather see you have this money than some company out there. Also, he's got about $100K in equity by not waiting to buy. The young man that waited until 2022 to put 20% down on a home for $380K, loan amount $304, actually has a higher payment by $300 per month because of the higher purchase price and higher interest rate. In addition to losing the $70K of equity the market would have given him, he also lost $7,000 worth of taxes back by not paying mortgage and paying rent instead. You gotta live somewhere, and the apartment that he was living in was costing him $1,500 monthly. That goes to nothing. Well, He would have at least paid down a loan by $14,400. Total losses by waiting, $91,400 in real money. To recap, there's no good or bad market to buy a home in. There is, do you currently have a home or not? If not, it's always a good market to buy in. If you have one, it may not always be a good time to sell, and we're gonna cover that on our next video. If you haven't already, hit the like button below for the YouTube algorithm and subscribe to the channel, and please do both these things. Guys, it would mean the world to me, and you guys are amazing. I hope you have an awesome rest of your day, and if I can be of any help in buying or selling a home, please call me anytime. Thank you again, and make it a great day.